For his thoughts on the mega caps, let's bring in Scott Chronert, head of U.S. equity strategy at Citi Research. All right, granted, maybe we still are at the Magnificent Seven. We remember who they are. We've taken some out, and we've played around with the Fabulous Five and the Fantastic Four. But let's do the seven, Scott. What should we do with those? Are they going to lead this year as well?
Well, I think you have to hold them. I mean, that's our view. Is we've been, consistently overweight tech, and the premise has been you want to hold on to these mega cap growers. They're earning their weight, if you will, in the indexes as a function of the fundamental dynamics underway. And aside from that, we do expect the market to continue to broaden as the year unfolds. But Magnificent Seven, Big Seven, whatever you want to refer to them as. They're 28% of the S&P 500 now, and they're contributing about 20% of earnings, and that's up from only 5% of earnings back in 2017. So our point here is that the business model maturation of these companies, the turn to profitability and significant growth in profitability is underpinning the market cap growth that we've seen here. So we think it's, to a certain degree, kind of deserved from here, but the stocks do become more idiosyncratic as we look ahead.
I mean, you'd always want to be in the Magnificent Seven, really. I mean, if you want to win it, you got to be in it, just like the lotto. That's what they say, Scott. But, there are some things to think about in terms of valuations. We know that tech is where the growth is. But then you got to worry about, if you do talk valuations, then interest rates and the prospects for higher or lower interest rates can affect, where multiples go. They're going to be the fastest growing companies, but it doesn't mean that they'll be the best performing stocks.
I think that's spot on. So the way we've been discussing it is, a lot of the discussion this week is CPI, Fed timing on first rate cut and so forth. And, we're very attentive to that for sure. But, for several months now, we've been saying we're much more focused on 10-year nominal yields than we are Fed funds, mainly because we do think, to your point, it sends a signal as to how the market will think about the valuation of these stocks. So, suffice it to say, we're using a year-end 5,100 target. We're not that far away at this point. Our mantra has been buy pullbacks, but part of what we're watching here is the direction of 10-year nominals. We feel much more comfortable with a valuation tailwind to the Big Seven with 10-year yields closer to 4%. We've nudged up to 4.25%, and we want to be careful to assess how the stocks could react if you were to work a little bit higher in the short term from here.
It's just a law of large numbers, Scott. Does that ever come into play? And if you ever believe that things are going to broaden out, when do the small caps have their day? I mean, do you go from $2 trillion to $4 trillion, or $1.5 trillion to $3 trillion? When do you make the decision to actually move into less well-known names?
Yeah, so I think the relative valuation setup for small caps is very compelling right now. Historically, you've gotten the bigger sustained moves for this part of the market in sort of early cycle dynamics, right? And so what we've been arguing here is you want to use the relative valuation setup, which plays to lesser confidence in the small caps generating outsized earnings growth, to leg into positions. Ultimately, what you're going to need to get to is a little bit clearer early cycle play. Now, Citi House views for a mid-year recession, so what we're trying to do is time it in relation to that. But I think what you're going to end up getting as the year unfolds here, as part of the broadening effect, is that you're going to continue to see the small cap regain its footing after several years of dormancy.
Citi's view is a mid-year recession, like a semi-hard landing, just a little bit, not kind of a soft landing that gets you a small negative print in a couple of quarters. Is that what you mean?
That's pretty much what we're looking at here. But, essentially where that needs to come from is you do need to see employment fade. You need to see some of the consumption data points come in a little bit. That's, from my equity strategy perch, it's going to be certainly possible. But I think what we've been arguing under the surface is that sector by sector, and we like to think of the S&P in clusters, growth, defensives, and cyclicals. Most of the equity markets have actually gone through earnings recessions already. So even despite a economics call for a mid-year, let's call it mild recession, our view is that the earnings setup for the S&P 500 is actually quite strong here. We're using a 245 estimate for full year 24, and that's even factoring in economic weakness in the middle part of the year as we navigate, lagging effects of Fed rate hikes to date. So, we're paying attention to it, but it just, like I said, where it has us right now is we're very comfortable owning U.S. equities. We're just a little bit less comfortable in chasing them as we cross through the 5,000 level. Look to be a little bit more aggressive buyer on pullbacks.
Where's your office, Scott? Where are you based?
I'm in San Francisco.
So that is
you're getting a background that's my look in a couple of hours.
Okay. No, it's just, at $50 an hour, I don't think you're going to be, enjoy your McDonald's while you can, because they're all going to be closed in a little while. Do you see that? $50 an hour minimum wage from one of your candidates?
I will say on that point, we recently went underweight consumer services. And so part of our thought process there is after the wage gains of the past year that part of the market's going to have a little bit tougher time holding margins.
You ought to go overweight moving to some other state.